Hi there, welcome to Kneppyinvest. Just over 2 years ago, I asked the viewers of this channel to provide me with a group of companies, either 3 or 5 companies, that they thought would outperform the market over the following 5 years. And then I collated the results, and then I came up with a portfolio of companies chosen by you. And then I came up with this portfolio totaling about $100,000. And then I wanted to track the performance of this portfolio over the next 5 years. And there was a reason behind this. And the main reason behind me wanting to do this was just to see whether a completely passive strategy could work in the long term, because it's not the sort of strategy that I personally use. I'm a little bit more active than being completely passive. So I decided to track the performance of the group portfolio versus two of my own personal portfolios that are a little bit more active. A less active one, which is sort of a long-term strategy, just buy high-quality companies and just hold those companies for as long as possible, versus a way more active strategy, which is just using momentum and trends in share prices. So I was tracking these three portfolios via share site, and I was doing monthly update videos, and then all of a sudden I stopped doing videos. And the main reason I stopped doing videos is because my share site subscription came up for renewal, and I realized the only reason I was using share site was because of this particular video series. And I thought, because the group portfolio is completely passive, I could just use Microsoft Excel to track the performance of that portfolio. So I decided not to renew my subscription. And because if you're not a subscriber to ShareSite, you can't track more than either one or two portfolios, I actually had to delete my two personal portfolios, or even just one of them, but I was still able to keep my group portfolio. And then I just decided not to do any videos in this series until the end of the financial year. And lo and behold, we are at the start of a new financial year. Hence, a new video in this series, a 2-year performance update to the group portfolio. Now, did I mention that the value of the group portfolio at the start of this project was $100,000? So keep that in the back of your mind if I did not mention it. Now, one of my initial problems with the group portfolio was an over-reliance on story stocks, but I did like how diversified the portfolio was. We had a lot of story stocks in there. When I say story stocks, I'm talking about those companies that have no revenue, that are not profitable. But alongside a lot of these story stocks, we also had some of the highest quality companies on the ASX and some very mature companies, dividend paying companies. So those companies include CSL, Woolworths, ResMed, BlueScope Steel, Sol Pattinson, Fortescue, and BHP Group. But some of those story stocks included Novonix, Lake Resources, BrainChip, Province Resources, Talgo Group, Obsidian Group, Pointera, Zip, Tezzeret. Even though some of those companies did have revenue, the majority of those companies were not profitable. Now, that sort of strategy, relying on story stocks, can work, and it did initially work for the group portfolio. And the high point in terms of performance for the group portfolio was at the end of November 2021, when the group portfolio was up 20.5%. And the majority of the heavy lifting for the group portfolio after 5 months of this project was because of Novonix and Lake Resources. In fact, Novonix at this point in time had a share price of $12 and had a return of $17,500, while Lake Resources share price was 88 cents, which gave it a return of $6,500. And you'll also notice that half the companies were in the black and half the companies were in the red. But then, unfortunately, things changed and story stocks became much less preferred in the market. The market wanted to see companies that had proven a business model, that had proven they can be profitable because interest rates started to rise. And you can see that with the performance of the group portfolio the last time I did a video in this series, which was at the start of October 2022. So instead of being up over 20%, the group portfolio was down 22%. But still, the two best performing companies at this point in time were story stocks. Lake Resources, which had a share price of 90 cents, and BrainChip, with a share price of 87 cents. And both those companies had returns of $6,700. And for BrainChip, that was Lake Resources, and from BrainChip, $3,100. You notice just behind BrainChip, we had Unity Group, which was taken over, and then we had those high quality companies, ResMed, CSL, mining companies, which were BHP, Fortescue, a defensive company in Woolworths, and then another story stock in Talga Group. And things have only deteriorated further for the group portfolio by the end of the financial year. It is now down 33.5%. And those two story stocks that were the best performing companies at the end of September 2022 are nowhere to be seen in the top 9 companies. In fact, Lake Resources share price has fallen from 90 cents to 30 cents. It's now coming 10th, while BrainChip share prices has fallen from, what was it, 88 cents down to 36.5 cents, and now it is coming in 13th place. And if you look at the top 10 best performing companies, there is a common theme here. Unity Group, which has been taken over, and in fact, that's the only company with return above $1,000. In fact, return for Unity Group is $2,200. But then after Unity Group, we have Fortescue, BHP Group, Talga Group, which is the only story stock left, Woolworths, ResMed, Soul Pattinson, BlueScope Steel, CSL, and then Lake Resources. So what's the common theme among those top 9 companies apart from Tower Group? They're all mature, not mature companies, but they're all higher quality companies with a dividend. And in fact, if you look at the dividend column here, the majority of those companies provide a dividend, including Unity Group, and the only company not in the top 9 that provides a dividend to the shareholders is Dus Group. And what is Dus Group? It's discretionary consumer, which is completely out of favor on the ASX right now. And every other bad performing company here has not provided a dividend to their shareholder. So a lot of these are story stocks without any dividends. And that's why the group portfolio has performed absolutely terribly over the past 2 years, an over-reliance on story stocks. Another thing I like to do is just compare the performance of my portfolios to a benchmark. And the benchmark I typically use is the STW, which is an ASX 200 ETF that is an accumulation ETF because it includes dividends. And what you want to see is the performance of your portfolio beating the benchmark, because if it can't beat the benchmark, you may as well just put your money into that particular ETF. And unfortunately for the group portfolio, it has significantly underperformed the market over the past 2 years with a total return of negative 18.4%, while the benchmark has provided a return of 4.8%. But after the first 5 or 6 months, the group portfolio was actually outperforming the benchmark. And the reason behind that is because of that over-reliance on story stocks, on unprofitable companies, because during that period, those sort of companies were in favor in the market. And then all of a sudden, with a rising interest rate environment, those sort of companies were out of favor in the market. So it just shows us, it should show us that actually being a little bit more active can be beneficial. But it also shows me that a completely passive strategy needs to be over-reliant on better quality companies. So let's talk about some of my takeaways that I have gained from this particular project. So one of the main reasons I decided to do this project was just compare a completely passive strategy to more active strategies. So I wanted to take away at least one thing from this project. Now, this project was supposed to last 5 years. I keep on intending to move forward with this project over the next 3 years, because who knows, maybe those story stocks will become in favor again in the next year or so. But one thing I've really taken away from a passive strategy is the need for higher quality companies that are dividend paying, because those sort of story stocks can come in and out of favor fairly quickly. They are more trading or companies you want to trade. So in my opinion, if you're really going for a passive strategy, you need to find quality companies that have dividends or quality companies that are growing and are profitable. And that really reminds me of my two personal strategies. So my two personal strategies are long-term and short-term. So the long-term strategy is just buying those high-quality companies that I just want to hold for as long as possible. So I'm talking about Apple, Amazon, Google, CSL, JB Hi-Fi, all those sort of companies that just keep on growing. Sort of companies you just want to own for as long as possible. Now, my short-term strategies is just taking advantage of sentiment. And it just seems like sentiment has significantly shifted for a lot of these story stocks over the past 2 years. And to be honest with you, you don't want to be holding those sort of companies when sentiment is highly negative. And that's why the group portfolio's performance has significantly underperformed the market because it's been over reliant on story stocks. The other thing to take into account here is time frames. So we're 2 years into this project. At this point in time, right now, after 2 years, the group portfolio is underperforming the market. If we stop this project after 5 or 6 months, you would argue that the group portfolio, that strategy was a really good strategy because it was significantly outperforming the market. So I think we have to extend this project at least until the end of that 5-year period, which I initially wanted it to be, because we just don't know what's going to happen in the next 3 years. There could be another shift in sentiment in the market, and maybe those out of favor companies like Novonix, like Lake Resources, like Rainchip will come into favor again. Who knows what's going to happen in the next 3 years? So time frame is very important, and also the ability to change strategies is really important, particularly if you like or love those story stocks. And don't be afraid of not owning those story stocks for a while when those sort of companies are out of favor. And I think this is very important. And I do know a few fund managers who do change their strategies from time to time. They do look at the macro environment and change their strategies. Not a lot of fund managers do it, but there are some fund managers who absolutely do that. Their ability to change strategies means their overall performance in the long term is actually higher than those fund managers who don't change strategies. And that's all I have for this video on the performance, the 2-year performance of the group portfolio. If you have any questions, any thoughts about anything I've mentioned in today's video, I'd love to hear your opinion and your thoughts. So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.